You're about to hear my conversation with Constantine Bomer, Head of Fixed Income and Portfolio Manager with Mackenzie Investments. Today, we'll talk about the potential and risks of investing in Canadian fixed income, what Constantine thinks of Fed independence and the path for rates in the US through 2026, and finally, why emerging market local currency debt remains a very compelling opportunity. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, and today I'm joined by Constantine Bomer, Head of Fixed Income and Portfolio Manager with Mackenzie. Constantine, thank you for joining the podcast today.
Thanks for having me, Rajan.
Of course. Now, Constantine, you've managed money through many economic cycles. I'm just curious to start off our conversation from your perspective. What is different structurally about this particular cycle? We're going to get into the nature of the cycle itself, but what's structurally different about this moment?
Probably the two biggest ones are that we're dealing with a geopolitical changing macro environment where we've had for many years, if not decades, a fairly straightforward way of looking at geopolitics, where you had one superpower and that was calling the shots. And that has moved over to a world where there is, multipolar would be the correct term to use here, but it basically means that there are multi-different groups that are all vying for interest, and that is creating an environment which is increasingly also bringing out tensions, but it is also creating possibilities for some countries to take advantage of that by greater competition and finding their right allies. And that is structurally different in how we have to think about countries. And obviously the US is at the forefront. We're here in Canada. We've seen clearly how the trade negotiation between Canada and the US are playing out. But that is one that we have to be very mindful of. And I would argue that investment professionals are not as versed on political assessments as they are on macroeconomic or individual markets or sectors or securities, because for politics, oftentimes people bring in their emotions into their decision making. And that is a dangerous thing when it comes to investing, but it is also quite hard to separate those two things. And that is a challenge that the market, I believe, still has to figure out. But those challenges provide structural opportunities also for managers that are quite aware of this. And the second part is that we are undergoing a technological revolution. I don't think that is too far-fetched to call it that way. And that is, we're in the knowledge industry, and that knowledge industry is being shaken up by Gen AI and all the tools that are coming with it. And that is putting a significant amount of emphasis on defining the value when you are able to obtain high quality knowledge at basically free amounts. So the average has become free. Excellent is still worth value. And that technological revolution is taking place right in front of our eyes. And that is a structural change of how asset managers will manage their portfolios.
Very good, Constantine. Thank you. I'm going to go back to how you opened your remarks. You touched on geopolitics. Normally, in our conversations, I would go straight to the Fed right about now. I actually want to start with Canada. In Canada, we have a lot of attention on the Building Canada Act, the Major Projects Office. It seems every week goes by, Prime Minister Carney is zigzagging the world, trying to sign bilateral trade agreements, really trying to get the animal spirits of the economy going. On the other hand, the data is not all that inspiring. So, as a fixed income portfolio manager, how do you approach and make sense of the current situation as it relates to Canada?
Canada is a big one for us, not only because we have a significant amount of our AUM in Canada, but it is also super interesting from exactly that contradiction. On the one side, we're seeing, let's start with the negatives. On the negative side, we're seeing housing market is in a absolutely terrible shape, and that is probably still getting worse because it is home sales. I believe most of your listeners are quite aware of how weak they are, but there is an entire industry which is based on housing, and that has been one of the, if not the, drivers of Canadian growth over the past few years. And that sector has become so large relative to other countries around the globe that this slowdown, and it is not only a slowdown, it is basically a grinding halt, has influences on employment and economic activity. So there's probably going to be, unfortunately, some more pain that is coming from that part of the economy. And that part of the economy is really large. Then we also have immigration, which was another major driver of economic growth in Canada. If a country is bringing in multiple percentage points of its population every year, all of those people, of course, need to buy things, and they are positive contributors to the economy. And right, there are apartments or houses, there's food, there's clothing, there's all kinds of expenditure that comes with it. And it comes from a base of zero because those are new people in the country that previously weren't there before. So that also has come to a halt pretty much in no time, right? That went from significant contribution to virtually nothing. Then we have the effect of what does all of this do to the economy? And the economy is one person's expenditure is another person's earning. And here we see that two large, really large drivers of economic growth have come to a halt, and that is leading to lower income in multiple different areas of the economy, which will then lead to lower spending of those people who are getting lower revenue or lower income. So that's the challenge. And then we have maybe tying it even back to the technological change that we're experiencing, a country that has had challenges with productivity over the past few years. If you are entering a phase where productivity is the name of the game, that could add additional pressure to the employment picture as companies are rolling out more and more efficiency enhancing measures, maybe at the expense of human capital that is being employed. So that's all on the negative side. And if we take a look at the stock as one of the most indebted household country with the highest household debt globally, that is a very dangerous position because that needs to be serviced. And it is also at a much higher interest rate than it was just a few years ago. So that's all on the negative side. And that is leading us, that is overwhelming for us and makes us believe that Bank of Canada will cut rates multiple times this year. We have a very differentiated view to the market. So that is a fairly strong position that we have. We do, however, see also really good activity from the government, right? So it is a renewed focus on natural resources, in our opinion, absolutely necessary, definitely steps in the right direction. A great tour, Rajan, you just mentioned it, of Carney going around the globe and signing deals and investment dollars that are projected to come into Canada. Absolutely the right steps, also, in my opinion. That is great. And probably also a renewed patriotism that is coming into the country that has been since the 51st state remarks earlier last year, but I think that momentum generally kept pace. And if I watch the ads for the Olympics, it is only underlining that renewed patriotism. And that is something that is, as you also said, reviving possibly animal spirits and is counteracting the negative forces. My fear is that the negative forces are too large and those will be hitting us first, but we're sowing the seeds for a great return of Canada.
Very good. Great opening on Canada and very detailed. Thank you very much, Constantine. Constantine, I'm going to transition over to the United States. We have recently nominated incoming Fed chair later in the spring, Kevin Warsh. I'm just curious. I can ask you a couple questions on the Fed, but first, very quickly, what do you make of concerns that continue to linger about erosion of Fed independence right now?
I don't have huge concerns. I think this will all play out reasonably well over time. And of course, there will be pressure, and that pressure will likely persist for the next few years. But I could also easily see that subsiding. Again, I'm not overly concerned about completely taking over control. I think the checks and balances are there and will probably prevail.
Very good. Now, follow up question. I'm going to ask you a two-pronged question on rates. You mentioned that the team's view in Canada is more dovish than the consensus view in the marketplace. As we look at the United States, what do you view as the path to short-term rates over the balance of 2026 right now? And also, if you could weave in some comments on how the 10-year will behave, which is, of course, much more responsive to how lenders feel about the fiscal situation and economic situation in the United States. What are your thoughts?
Maybe first, market thoughts are the market is currently saying that we will see two more cuts in 2026 in the US. I don't think we will see them. So I actually believe that there's no more rate cuts coming from the Fed. So that is a differentiated opinion to the market. And I believe we don't need to see rate cuts because the US economy is actually doing reasonably well. We will see how that plays out over the next few months and quarters. I'm not overly optimistic about the employment picture, but I am quite optimistic about the overall growth numbers because productivity seems to be doing exceptionally well. So I don't believe there's a need to cut rates, but there might be a window of opportunity where inflation is low, where employment comes out a little bit weaker, and the Federal Reserve can sneak in a cut or two. But I don't think we're going to see a meaningful reduction in short term rates due to economic weakness. I think it is more we're here, that's a pretty neutral zone and base case is we'll not see any rate cuts anymore for 10-year bonds or longer. We have a short position on right now, so that is a view that we think that rates will actually go higher in the US. That would be consistent with us not believing the need of further rate cuts. And there is, I believe, in general, the lingering concern in our mind, which is the US economy is growing in nominal terms phenomenally fine. So we're talking about 7% nominal growth. So that is partially inflation and partially just the overall growth numbers. They are looking very, very, very strong. And such a strong economy doesn't need rate cuts and probably has potential to see rates going a little bit higher in 10-year space.
Constantine, in many of our prior conversations, both on the podcast and in person, when we talk about potential recession, you've commented that oftentimes this occurs due to a policy mistake. As you look at the market, what do you think is a greater likelihood of a policy mistake in the US, cutting too aggressively or not cutting as we go through the balance of 2026?
The Fed has a bias, and I believe that bias is to cut rates. So if there were to be any wobble in economic data, I believe that they would be quick to cut rates. I don't think they would hesitate all too much. So I don't foresee that being the greatest risk. I think they will be quite loose for some time. So the bigger risk for me is that they will not hike rates when they actually should. And there is the potential of those maybe inflation coming back. It's not a high concern of mine, but if I had to choose between those two, I believe that the Federal Reserve has a bias to be too late to hike rates. They don't have a bias to be too late to cut rates when things get bad.
Makes a lot of sense. We've spent a lot of time on the macro and on rates. I want to spend a couple minutes here on credit in both the investment grade and high yield worlds. I think we're looking at spreads near historic heights. As a portfolio manager, how do you navigate this market and where do you look for opportunities?
Things are tight, things are expensive. They should also be expensive because the risk of maybe a major credit event is not in front of us. Economic growth, as I mentioned, is quite strong. Policy support is there. There are also maybe increasing support for companies that are domiciled in the US by the federal government. So there's a good amount of positive support. And there's also on the consumer side, is going to be close to record levels of tax refunds that are probably in front of us. So the situation looks reasonably good. There are pockets of weakness, and we need to pay attention to those. The pockets that are quite apparent are SaaS, so that is software as a service. So that is more of an equity story than it is a fixed income story, but we have to be mindful also in the fixed income space because we're lending to companies for multiple years. And if the business model is changing dramatically by the advent of a completely new technology that has the chance to disrupt their business model, that needs to be taken quite seriously. So that is one pocket. Another one is on the more private side, that is equity and credit. There have been last year some concerns, but those seem to have abated also to a large extent. But we still need to keep an eye, especially also as it relates to those software companies in those books. And the last one is on the big hyperscalers. And here the names would be your Microsofts and your Oracles and companies that are just spending billions and billions of dollars to build new data centers. And here the question is, if it is funded from free cash flow, no problem. If it is funded by leveraging up, that could create some difficulties down the road. But those create opportunities. Risk and opportunities are both two things that we like because it allows us to provide differentiated views and hopefully benefit in the market.
Very good, Constantine. Now, we have spent almost all of our time talking about Canada and the United States, but of course, you and your team have a global mandate and are global investors. For my final question, I'm curious, what is the opportunity set as you look outside of Canada and the United States, whether it be in the emerging markets or EFI? What are your thoughts?
We've been pretty big fans of emerging market investments in our mandates, and our preferred way of expressing that is to own local debt. So that would be a Mexican bond in Mexican pesos or a Brazilian bond in Brazilian real. There are also plenty of bonds which are denominated in US dollars. So Brazil would also have bonds denominated in US dollars. But we do like the ones that are in denominated in local currency because it also has the extra kicker to the portfolio as to what happens with the currency. So the view is not only how is the fixed income market doing in Brazil or in Mexico or South Africa or any other country, but also how is the currency performing relative to the Canadian dollar. And here we have a fairly positive view on emerging market currencies and their bonds because they're still yielding quite attractively. So you can get double digit yields in Brazil or in Colombia and high single digits in Mexico and South Africa. And that looks pretty good because the market is seeking returns. So there's a drive towards higher yielding investments, and we have a relatively benign environment as it pertains to the US dollar. Because the US dollar, whether it matters or whether you think it should matter for Colombia or Brazil or South Africa or Indonesia, the US dollar is always the most important thing that they will look at. And for as long as the US dollar is not gaining in strength, that is generally a very good environment for emerging markets. And the US dollar is actually losing in value right now, which is providing an extra boost to all those emerging market bets.
Phenomenal. Very insightful. Konstantin, I'm just looking at the time, and although I could speak to you for hours on end, I'm going to conclude our conversation here, and I'm already looking forward to having you again sometime soon. Thank you again for joining the podcast.
Always a pleasure.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.